What's up, Gold Miners? Today, we welcome to the program Mark Khuri. Mark is the co-founder of SMK Capital, a private equity real estate investment group that focuses on a diversified real estate investment approach across multiple asset classes as well as sponsors. We kick off the episode by dissecting this diversified real estate fund of funds model that Mark runs and some of the pros and cons of investing into this kind of model versus investing directly into individual deals and or funds. Later on in the episode, Mark dives into recession-resistant real estate investments and some of the things that you can do to recession-proof your portfolio. And finally, we end the episode by discussing some of the alternative real estate strategies that Mark is bullish on over the next couple of years, including investing into properties with tax abatements and triple net sale leasebacks. Because of Mark's unique setup, he's had an opportunity to invest in a myriad of different asset classes, as well as across a myriad of different sponsors. So he really is a wealth of knowledge when it comes to identifying great opportunities, investment trends, as well as vetting deals and real estate sponsors alike. So lots of knowledge shared in this episode. Whether you are brand new or a seasoned investor, there is lots that you can learn from Mark. So without further ado, everyone, let's welcome to the program, Mark Khuri.
The Gould Mine Podcast.
Mark, welcome to the Gould Mine.
Thanks for having me, Danny.
Yeah, this is great, man. I'm excited to chat with you and learn. I really share with the audience what you're doing right now, and because there's some really interesting things that you're doing in the fund space here in across multiple real estate asset classes, right? So you're not really just focused on one. You're doing I would say more of like a diversification, like a more diverse fund structure, and so I'm really curious to like dive into all of that. But before we do that, like I want to just start with the backstory of like how we got here. You started this fund. What was it? 18 years ago? I read somewhere. It's like you started in the beginning. You started like right around 2006.
I started investing in 2005. We started our company formally in 2010. So,
okay.
I'll give you a quick background, Danny. Happy to kind of share with you where we've been and why we continue to focus on diversification, especially today, and why we select the asset classes that we do select, because a lot of things we don't invest in, and we can talk about those too. But essentially, I got my start in corporate finance, worked in, W-2 job doing budgets and planning, internal auditing for a number of years, and started investing on the side in predominantly single family, small multifamily, 12 units or less. Very heavy value add stuff, Danny, back then. This is 2005, so almost 20 years ago. You buy your first fixer-upper and, sleep in it and pick all the paint colors and do the flooring yourself and then cash out and go get another one. And so from 2005 to 2010, I was basically doing that, after work with my brother, with my parents. We pooled some capital together, just family. And we were buying some stuff on the courthouse steps, foreclosures, REOs, short sales, distressed assets, Danny. You could buy them back then for pennies on the dollar, right? We were basically getting some stuff 50, 60% off what it was previously sold for. But it needed a lot of love and attention. A lot of them were boarded up for a couple of years. And so, once you get in there, you never know what you're going to find. So higher risk investing. And then we built up a portfolio. By 2010, I left the corporate world and went full-time into real estate. I was hooked, And so we started raising capital from other people outside of our family, really just friends and colleagues, those that already knew us and trusted us, of course. And we were an operating partner in the single-family and small multifamily space for the next 7 years. We built a portfolio of a little over 60 properties across multiple states. We've since divested all of those assets. But essentially, timed the market well, not knowing what we know now. If we knew what was going to go down back then, we probably would have bought anything and everything, right? And so, it was a scary time. It was hard. It was difficult. We thought the world was falling apart, of course. So just investing through that recession. One of the key things is we just never sold anything at the wrong time. That's how you lose money in real estate. And so, fast forward when I left corporate America, Danny, I had a 401k just kind of sitting idle. You can't invest in your own deals. And so I opened up a self-directed IRA, moved some money over to that, and started investing as a limited partner in other operators' deals. I wanted to get diversification in my portfolio. So started investing in mobile homes and self-storage and senior housing, student housing, vacant land, oil wells in Texas. I mean, done a lot of stuff over the years. After about 5 years of doing both single family, small multifamily as an operator, then also passive investing as an LP, we had a pretty good chunk of data where we could essentially analyze risk versus reward and say, gosh, where's the best place to focus going forward? And we came away with essentially a change in business strategy in 2017. We decided to start investing by partnering with operators that we had already been working with in other asset classes. So one of the first syndications that we did with another operating partner was in the mobile home park space. And so we continue to do that today. Our main focus today is really we've evolved to a private equity real estate investment firm. We use pretty much all of our deals come from relationships we have in the industry. They provide us with deal flow. We're looking at 10 to 20 different deals a month. We invest in 4 to 6 a year, depending on what's going on. And so roughly 2% of what we see we'll actually put money into. Let me pause, see what questions you have there.
So is this a fund of funds or a co-GP structure that you're doing predominantly, or how are you structuring these deals with the operators?
Yeah, we do both, Danny. It just depends on the deal, the size of the deal, operating partners' need for capital, the relationship we have with them. A lot of them are fund of funds. Most of the time, we're getting better terms for aggregating capital, managing our own investors in-house. And so the net return to our investors is really comparable to what someone might get if they went direct. But they don't have that extra layer of analysis, vetting, underwriting, and of course, diligence and relationships, right? So a lot of deals, you just wouldn't get access to. Without knowing the right people. And the other thing we do a lot of, which my father was a big integral part of this when we first started our company, is we create our own funds. So we might, over the next 10 to 12 months, the 10 best deals we find, we'll put them all into one investment entity and spread our capital and diversify across different operators, different asset classes, different regions, different strategies within those as well, just to get really like a curated, unique, exclusive investment fund for our investors. They love that. It's much lower risk without sacrificing on return, which everybody's looking for, of course.
That's really interesting. So, by the way, we might have some stuff to talk about offline, but while we're on the podcast, we'll stick to the task at hand, which is one of the things that you've talked about before is diversification. You've talked about it many times on several podcasts that you've been on. When looking at the advantages of the way you just described one fund structure there, where you're like, hey, we're going to take your money, we're going to park it in 10 different opportunities across different asset classes and operators, which I think is actually very brilliant in a lot of ways, because you're mitigating a lot of that risk. You might not you might be mitigating some of that upside too, right? If one of those really hits pay dirt. But what asset classes are you predominantly investing in nowadays? Like where are we seeing the most action right now?
Yeah, great question. So our 4 top asset classes are mobile home parks, self-storage, some apartments, and typically triple net industrial sale leasebacks as well. So we love those for a lot of different reasons. They're not similar, but they all provide what we think is lower risk and still very attractive return. We also do some private debt funds as well, Danny.
Love it. Yeah, that makes a lot of sense. You kind of have to do both, right? Like if you're right, because I've actually thought about doing, and this is why I want to talk to you. I've thought about doing something like exactly what you're doing right now. And it seems to me like if you're going to be investing in a lot of equity plays, you've got to balance that out with some debt plays too.
I mean, depending on your goals, right? It's all risk and reward. So if you're pleased getting, 9-10% cash on cash without any upside and no tax advantages, a debt fund could be a great place for you to invest. That isn't necessarily our target. We're really trying to achieve better than that for our investors.
Yep.
And so we find that debt funds are a great portion or allocation of a portfolio versus just direct investment.
So one of the questions that comes to mind is you're like, hey, we're diversified across these, 4 primary asset classes. Is it what makes you or what qualifies you to be an expert in those asset classes? Is it just the decades plus experience now and having invested in these as a limited partner and general partner? And when you were starting, right, what qualified you to, really feel like, hey, I could go out there. And of course, like some of this is a sales job, right? You do have to sell these people on why, so I'm assuming that you did a good enough job to sell these people on why they should trust you. But I'm curious, like, what that process was in terms of like creating the necessary qualifications to like go out there and be able to deploy this money across different asset classes that, are all different in some way, shape or form.
Yeah. Great question. I mean, as we all know, trust takes a long time to earn. And so being in the business for a long time helps for sure. Danny, we have a great track record, and we also have a lot of, positive references from investors that have been with us for many years. And so we've been through cycles. We've been through a lot of things, right? None of this is easy. I think what qualifies us, that makes us a little bit unique, in addition to experience, we were an operating partner, right, for over 7 years. And so we understand operations. We're not experts in every single asset class in operations, right? So we're not going to go out and try and operate a mobile home community, but we're dangerous enough that we can vet and underwrite operators to see if somebody is going to be able to do it better than us, much better than us, and more consistent with us. And if they are, then they're worthwhile, partnering with them, or at least determining if there's a partnership viable there that's worth doing. So operations experience is a big plus. We've managed many tenants in different states, many property managers in different states, many renovations, you name it, dealing with cities, taxes, utilities, everything under the sun comes to operations. You also have, for me, being a finance background, being able to underwrite and vet the financials and the numbers. You put the two together, operations and finance, and you tend to have a pretty good way of looking at things that maybe not everybody else has, right? So a lot of our investors are, they're passive from what the capital they allocate to us, of course, is passive. They're not looking to get into the weeds. They're trusting us to do that. They're trusting us to make sure that we're being very selective with what we're putting capital into. A lot of them are, business owners, doctors, lawyers, attorneys, entrepreneurs. They don't have the time, the resources, or maybe even the experience or knowledge to do it themselves. And there's so many deals out there, Danny. So it's like, where do you begin? Right. So if you're not doing this full time and you haven't been doing it for a long time, you're going to be at a slight disadvantage. Doesn't mean you can't do well, but it's all about lowering risk. Right. And so that's where we come in and really help our investors navigate what we consider to be a pretty volatile and uncertain market moment. Although I think the worst is behind us, but we can get to that later.
Yeah. Well, and what's interesting is you just kind of hit it on the head, right? With retail investors, the amount of due diligence that you need to do in order to get comfortable with a deal and or a sponsor. I mean, I feel like these people have made their money for a reason. They're not going to just like write a check, right? They're going to want, most of the time, right? They're going to want to know who they're getting into bed with. And so you effectively, in structuring it this way, take that part out of the equation. As long as they feel comfortable with you, then you can direct that capital into the investments that, based on your experience and your track record, you feel are the best, places to invest at that point in time.
Yeah. I mean, the other way we do things, Danny, that helps kind of reduce their risk as well is we don't really create blind pool funds where we come up with this concept, hey, we're over the next 12 months, we're going to go do X, Y, and Z, but we haven't actually found any deals yet.
Right. Yeah.
We almost always have a live deal or two or three that we're going to put into a portfolio so that folks can analyze it before deciding if they want to invest. Right. And a lot of times
that makes sense.
We do one-off asset acquisitions as well, where we'll just invest in that one property at 123 Main Street. And so when we present that to folks, they have lots of details and a data room full of information that they can get as deep as they want into their own analysis as well.
Yeah, no, that makes a lot of sense. So what it sounds like now, I'm probably going to use some terminology that not everyone in the audience knows, but are you doing like SPVs? Is that like how you're investing into these deals or what?
Yeah. So for every investment that we create, we have its own LLC, its own EIN, tax ID, its own tax return, its own bank account. So that entity will then raise capital from investors. Yep. Everyone will have a pro rata share and ownership of the company. And then our company will invest into the deal or multiple deals, depending on what we're doing with that entity and the business plan for it.
Love it. Now, when did you switch to this model? Because it sounds like or are you completely divested from operations? Like, are you no longer operators in any of your properties, or are you still operators in some of them?
Yeah, we've divested of anything that we were the operator, Danny. Wow. And so for 7 years, we're the operator. And let's say the last 8 years, we've essentially pivoted and moved over to more of the private equity funded funds model.
What made you decide that was the right move? Like, what was it that sparked
a couple of things, right? So again, as I kind of noted earlier, we had been investing personally, but not our investors' capital, into other deals for 5 years at the same time while we were doing our own deals as an operator. And so again, we had data. We could say, okay, we want to continue to focus more on the asset classes I mentioned earlier, but we're not experts in operating them because they were doing well, right, Danny? We were getting great returns.
Yeah.
Which we consider to be lower risk investments versus what we were offering our investors. And so part of that was diversification and reducing risk while also earning a really attractive return. And the other part was just looking at the market cycle, right? So if you think about 2017, 2018, there was a lot of fear of a recession coming at that part of the market cycle. And we saw that. We saw some indications that there could be a market correction pretty soon. And historically, single family homes tend to not fare so well during a recession. The value of single family homes is often correlated to the overall economy. Not always, but that was definitely the case in 2008-9. So we wanted to focus more on investments that were valued based on the amount of income that they earned, like a business, of course, and be less correlated to the overall economy. And so that was a big part of when we pivoted out of the single family, small multifamily space into more, institutional quality commercial real estate.
Got it. Okay. And when you so just to be clear, right, the majority of the positions that you held that were where you were the operating partner was more single family properties. When you realized, or when you noted, like when you were, I would say, for lack of a better word, like afraid of what was going to come or whatever, you decided to liquidate those properties. You then decided to no longer be an operator and just focus primarily on investing into like larger commercial deals, mobile homes,
I would say,
storage.
Right, exactly. We didn't buy anymore. We didn't necessarily liquidate them all at the same time. We liquidated them over the next 5 years, honestly. So it was a while. Right. We let the business plan play out for each one of those properties because each property we buy has a business plan associated with it, with a duration. How long do we plan to hold the investment, or what type of NOI growth are we trying to achieve in order to sell it and do well? And so really the pivot was more like, let's pause on continuing to acquire and invest in single family and small multifamily and focus our attention on, for the last 5-6 years, we had been investing as LPs with different operating partners. And let's go focus on partnering with them and raising capital for their deals, one at a time, slowly utilizing those relationships, where we essentially had vetted and tested these folks and their groups and their strategies with our own money first before bringing our investors on board.
This is awesome, man. I'm really excited about what I'm hearing, because this seems to me like the new model that makes sense, right? You've got, because really, like in a traditional fund model, right? Or the funds of yesteryear, it's like three businesses in one, right? Asset management, acquisitions, and investor relations / fundraising. Right? So you've got like three real jobs there. And maybe acquisitions can be like, given that probably the asset management, right? But like maybe also like investor relations / capital raising. But I think like in the future, there's going to be a lot more firms like yours where we're just focused on raising capital and placing that capital in the best possible deals, and using your knowledge to vet the sponsors. Because when sponsors are pitching their own deals, you're getting a lot of fluff, and your job is to extract the fluff out of it and be like, dude, I can see through the bullshit, right? And so it's really interesting. And I think like a lot more, I think it's going to actually like at some point almost completely diverge. Because I'm starting to see more things like this pop up. So it's very interesting.
Yeah, let me add another point. So regardless if you're like an active investor or passive investor, if you have property, it needs to be managed by somebody, the property manager or the property management team, depending on the size. And then there's oversight on top of that, right? And so if you think about like a large commercially run institutional, 400 or 500 unit apartment building, you're going to have a team at the property every single day in the leasing office. There's a manager of the property. There's usually a regional manager on top of that. And if the management firm is not vertically integrated or in-house with the operator partner and they're a third party management firm, then the operating partner needs to oversee them. And then there's a level of asset management that overlooks and oversees the day-to-day operations in conjunction with the property management team on the ground. And then there's another layer for us. We're on asset management calls, monthly, Danny, on our properties with our operating partners and property management team. And so we're pretty heavily involved in the day-to-day oversight. I won't say we're not leasing, we're not vetting residents, we're not doing that. Of course, we want our operating partners to handle that day-to-day operation, but we're checking in with them consistently to make sure they're doing a good job, right? It's the whole manage the manager concept. It's more important than ever today, and the devil's in the details. And staffing is a problem across the country. Finding great people to run a lot of these properties isn't simple. It's not easy. And so I share this with you because, although we've pivoted away from being an operating partner, we are in the weeds on a lot of our properties consistently to just oversee and make sure that they're going well. And if they're not, what's a corrective action and how quickly, and set timetables up and hold people accountable. And it's a huge team effort that goes on with that kind of consistent oversight on these properties.
So, and actually that's refreshing to hear, right? Because I do know some fund of funds guys who, they almost brag about how after the deal closes, it's just like mailbox money and they don't really have to do anything after that. So it's refreshing to hear that you're at least more active in the oversight, right? Not necessarily that you have like maybe a ton of influence over what's going on, but that you at least keep tabs on what is going on, so that like you don't wake up, 6 months later and are like, what do you mean, the property isn't performing, right? Like, or Absolutely. Like 3 years down the road,
Yeah. Tracking and managing managers is critical. I just think it's so important. And if you don't track them and they know that you're not tracking them and following up with them, it can create problems down the road that you don't see.
Yeah, that's very fascinating. So switching gears a little bit, you've mentioned before the idea of like recession resistant. Well, I'll say that 5 times fast. Recession resistant real estate plays. So given the landscape that we're facing right now. How do you go about identifying these types of recession-resistant plays? And then, are there any specific locations that you're focused on right now that fit that bill, or is it more of like asset class combination of the two?
Yeah. So let me clarify what we mean by that, because we've been focusing with recession-resistant strategy since 2018 when we pivoted because we thought there was going to be a recession. So you're looking for assets or investments, call it, Danny, that have a high likelihood of continuing to perform through a market downturn. And what does that mean? It means that the value of the asset isn't likely to go down just because the economy is going down. They're not correlated. And you also want to see if you can find investments where demand for the asset or the space that you're offering is going to remain consistent or go up if there is a recession. And so the first one that comes to mind for everybody is mobile home parks. It's the most affordable housing solution in the country. There's a lack of supply and you can't really build more. The demand keeps going up. So, Econ 101, demand increasing, supply flat or declining. You've got a pretty good recipe for long-term growth. And you do see during tough times historically that the demand for affordable housing goes up. And so, we're in that situation today with where the economy is, where our housing prices are, the delta between the cost of home ownership and rent has never been higher before. And so you have a lot of demand for affordable housing, and we don't think that's going anywhere. There's a huge deficiency in this country for affordable housing and housing in general. I think there was a recent study that came out and said there's 4 million apartment units deficient. And then if you look at the affordable component of it, it's even higher. And so I don't know that we're going to see that number catch up in the next decade unless there is a major change in development, right? You have to increase supply, and there's so many constraints to doing that, not just the fact that it usually doesn't pencil, but it's one of those situations where we're trying to find ourselves in an investment that we think is moated. There's very high barriers to entry and very high probability of the properties and continuing to perform and be in high demand.
Okay, that makes sense. That makes sense. So let's focus on a specific asset class then. You mentioned self-storage being one of the assets that you're invested in right now. Point blank, because I feel like maybe 2 years ago, self-storage was like all the craze. And then over this last year, I've heard some people getting out of self-storage. So the first question is just like very simply, is self-storage still a good investment in your eyes?
Yeah, absolutely it is. Has it gone through a little bit of underperformance in the last couple of years as a response to high interest rates and inflation? Absolutely. So a couple things to be wary of in self-storage. You have to watch out for new supply. That is the biggest risk in self-storage. It's very localized. And so there's actually some markets in the country that have a ban on any new self-storage being built because they're oversupplied. And so they don't even allow it. And so you got to be careful of what is out there. And so that's one of the things we're looking at all the time is what is the current supply and the current demand in a local marketplace whenever we're doing a self-storage investment. It's really easy to build new, right, Danny? You can find some vacant land, build new self-storage in a very short period of time, and the property competes directly with the old stuff. It's not like apartments where if you build a new one, most likely it's got much more amenities, much more curb appeal. It's more attractive, higher ceilings versus older apartments, and they usually command a much higher rent. Well, self-storage is, $110 a month for a new one or an old one for, a 5x10, depending on the location. And so you got to watch out for that. Why do we continue to invest in self-storage? Well, historically, it has done well during downturns. The amount of people in the U.S. that continue to rent self-storage, it keeps going up. It's 11% of the U.S. population today uses self-storage. That's massive. And so We're just a society that likes to buy stuff and don't have room for it. And we're seeing a lot of downsizing due to the high cost of housing. So people are electing to invest in storage. Another point that we love to see that makes it, I would say, unique is the leases are monthly. And so it allows you to adjust up and down pretty quickly your rent roll.
Yeah.
During a tough time, if there's a lot of new competition that gets built or you're seeing a softening demand in the market, you can lower your rents pretty quickly. And during good times, you can raise them pretty quickly. So it's got that flexibility that you don't see in most any other asset class.
It's interesting. Other than new supply being introduced to the market, what are some other factors that investors should be on the lookout for?
Yeah, I mean, a lot of it comes down to demand and supply, but also if you think about on the ground team, who's managing? What is the ability to increase occupancy? What kind of marketing measures are being in place right now versus what can you do to grow the value? And so we're always looking at value add investments, Danny. Almost everything we invest in, there's a business plan or how we're going to make it better and how we're going to increase in that operating income. So for storage, some of the things we like to see is, we've got an operating partner that we've been investing with for 4 or 5 years now. They buy specifically or strictly from mom and pop owners, call it direct to seller. They don't use typically agents. They have a team of cold callers that just call self-storage owners, and they've been doing that for 10 years to try and cultivate deal flow. And what they're looking for is they're looking for the mom and pop owner that is, there's human error. They're mismanaging the property. Right? So what does that mean? It recently acquired a self-storage facility in Texas. I think it was about 72% occupied. Okay. I actually went to visit the property as part of due diligence. I typed the name of the storage facility into Google Maps. It took me to the competitor's property, the wrong property, because they had the wrong address and it was just not named properly in Google. That's a very easy fix. Okay. Let's start with that. Number two, they don't have any online presence where you can't even, on a website, you can't rent a property online. I mean, that's very low hanging fruit. Okay.
Yep.
They're not doing any marketing and rent. There's a mailbox attached to the office and you just put your envelope in it. And apparently the husband had passed away. There's an elderly couple and the wife was no longer managing your property. And so you can see when you buy something like that, assuming you can buy it right, you don't necessarily think, oh gosh, is there going to be a recession soon? What you're thinking about is, let's get this thing professionally managed ASAP. Let's instill all these different procedures for rent collection, for marketing, for leasing, and let's raise rents. At this property, they hadn't raised the rents in over 10 years. So that's the kind of stuff where you want to try and focus on how can we improve this, and do we have a lot of conviction around the business plan to be able to grow them in operating income?
Yeah, I mean, that makes a lot of sense to me. And same thing in hotels. So I don't know if we talked about this before, but I'm in hotels, right? So it's the same thing, right? There's a lot of, I mean, when you're looking at value add, you're really looking at renovation or mismanagement, right? Like this property needs a renovation or a rebrand, or it needs to be management. And if you can kind of hit all three of those, rebranding, renovation, and management, then, you can hit those grand slams. But that's interesting, just like thinking about it, there's this, it's almost like a universally true statement where like, those are the main value add components in most real estate plays,
Absolutely.
So, so that's interesting. And most investors don't have the wherewithal, or like retail investors don't have the wherewithal to even understand how to vet all of those potential things. So obviously it sounds like you have the foundational knowledge required to go out there and vet those deals, which is a massive, massive value to the people who invest with you as opposed to investing direct. Now, another question for you, and this is something that, a lot of, you probably talk to all your investors about, but considering the size of your investment into a deal, you might be the sole LP, right? Or like maybe a large percentage, a large portion of the investment needed to do the deal. So because of this, you typically get better share class or better share classes, right? So you can usually negotiate like a superior fee structure for your, and like a better promote structure for your investors as well. So how to walk us through the logistics of like what those negotiations look like to kind of like make things better for the investors that choose to invest with you, as opposed to just saying, hey, I'll just go direct to the sponsor.
Yeah, absolutely. I mean, it has to be a win-win, Danny, right? You got to create a relationship with the sponsor operating partner where we're providing value to them. And sometimes that's through due diligence. Sometimes it's through capital. It could be a combination of both. But when it comes down to negotiations, what we're trying to achieve is a very strong net ROI to our investors. And so that's what we look at first and foremost. Is this an attractive return for our investors? And a lot of times we negotiate a higher preferred return, a higher split above the preferred return, maybe a lower management fee. We sometimes get consent rights as well, where we're a little bit more on the GP side. If they want to refi or sell or change the management company, et cetera, we have to consent to that ahead of time. And so it's more of a partnership in that structure. And what that helps do is reduce risk, right? And so all these measures are really just to reduce risk and get a strong return.
So I think it goes without saying that some of the most obvious advantages to investing in real estate outside of like, cash flows and appreciation and all that are the tax benefits of real estate. And so as a direct investor, as someone who is investing directly into these deals, there's, K1s that are issued, depreciation, write-offs that you can kind of take advantage of. But like, what, if anything, changes when they're investing into a model like yours?
Not much. Everything we do pretty much has favorable tax advantages, passive losses, usually in the first 1, 2, maybe 3 years, Danny, that flow through direct to our investors. Since remember, LLC, it's all pro rata. And so our CPAs, we get the K1 from our operating partner for our entity. And then our CPAs will do the tax return for our entity and provide all of our investors with their K1, which is where you'll see the passive losses. Even if we're getting distributions, of course, right? That's usually the goal. So we're always looking for investments that provide cash flow year one. And then we want that to be growing, but also, for tax purposes, a passive loss flowing through to our investors.
Yeah. Okay. Makes sense. That makes sense. So what I'm hearing is that by investing into your model, there are typically greater financial incentives on the front end due to the increased leverage and negotiating power that you have as coming from like a fund as opposed to just like a single individual investor. So you have a high, like your bargaining position's a lot higher in those situations. Plus, there's no necessarily like decreased tax benefits by investing into these sorts of SPVs or like fund-to-fund models.
Yeah, I think you nailed it, Danny. That's pretty much it. We obviously charge a fee for what we do, and so there's a
not free. Yeah.
Yeah. Just look at the net return to your investor, right? That's the name of the game.
Yeah.
If your fee is too high or your operating partner's fee is too high, it's just not going to work. And so everyone has to win. That's the way you got to structure these deals.
Outside of the typical investing strategies that we've discussed today, we've discussed mobile home parks, kind of a little bit, storage. You've also talked about like maybe alternative strategies. And so could you share maybe a few alternative investment strategies that you maybe are looking at, maybe not necessarily done, but are aware of that you might be considering in the future? Talk to us about what's on the horizon for you.
Yeah, I think there's two that are not well known. One of them is in the apartment space, Danny. So when I said earlier, we invest in some apartments. For the last 2 years plus, we've been really heavily focused on tax exempt apartments where we don't have to pay property taxes. And so that's a niche in a niche, right? And so I mentioned that as an alternative because just not a lot of people know what that is. But essentially, most of the time, what we're doing on these deals, you're taking a seller's asset that we're going to acquire. The seller is paying property taxes on it. But during escrow, our operating partners put in place a property tax exemption. It's a tax abatement. And essentially, you're partnering with a local municipality. It's a public-private partnership where you, most of the time, are allocating up to half of the units for an affordable component. So you're essentially providing affordable housing. And that is tied to the area median income, which is a formula. And in exchange for that, you can get, a 99-year property tax abatement. You also get much more favorable financing. Agency debt has better terms for affordable properties. A lot of times it's 7 years interest only, fixed rate, lower borrowing rate than you would get on a standard market rate property. And so that's one area that we love to invest in. We continue to invest in. We're going to keep investing there. The other one I think that's worth noting that we're going to keep investing in is triple net industrial sale leaseback. I know it's a mouthful, but basically what that is, Danny, you've got an industrial building with, it's usually a manufacturing company that's doing something inside that space. They own the real estate. A lot of times, not always, but a lot of times the company is growing and they're getting acquired by a private equity firm. Private equity firm wants an injection of capital to continue to put back into the business and grow it more. But they're not real estate guys. And so they say, look, let's sell the real estate and then we'll lease it back. So you don't need to move for anything.
Let's sell the best part about this.
In their view, it's not, right? Because they don't know real estate. And so they want to put money back in the business and expand operations so that they can, increase their bottom line. But what that
sounds
does
good to me.
It's like another niche within niche, right? And so we like this space for a couple of reasons. Essentially, what you do is you have a situation where you're 100% occupied at the time of acquisition because the tenant's already there. And you're leasing the property back to them. It's usually for 15 to 20 years. Absolute triple net, which means every year the expenses are the tenant's responsibility. Property taxes, insurance, maintenance, utilities, repairs, they have to pay all that. So your expenses as a property owner are zero. Significant hedge against inflation, where expenses have been going up. In addition, you build in rent escalation clauses into the lease. So the rent goes up every year on a predetermined rate. That could be from 2 to 4%. And so we love that investment because they typically, for what we're doing, we do those in portfolios. So we reduce risk from a single tenant lease structure where you have maybe a dozen different properties, a dozen different tenants. But you have a situation where you get nice cash flow right out the gate, day one. And it's very consistent, kind of steady Eddie income. We love that.
Yeah, that's those are some very interesting niche, like very, very niche strategies. But man, I learn something new every day. That's the beautiful thing about doing what I do, man. Is like it's mostly a learning play, Like I'm just this is fantastic. Wow, where do I want to end here? Because we are running up on time.
Sure.
But we've got time for a couple more questions. You look at a lot of deals and you seem like you're very in tune with the real estate market in general. So I'm going to ask you something I don't ask a lot of people anymore because everyone kind of says the same shit, but like, I feel like you are going to keep it real. What's on the horizon in the next 5 years for us in the commercial real estate sector? What do you see coming?
Yeah. Gosh, crystal ball question. So,
don't you have one? I think I see one right there behind your desk.
Yeah. So, here's what I'll say. You got to look where we came from and where we think we're going because nobody has a clue. But obviously, the Fed has increased interest rates fastest pace in over 40 years. That has put I'd say it's a major market correction. We've seen 20 to 30% decline in pricing across most commercial real estate asset classes, depending on where and what, of course, and vintage. But it's also stabilized. We're starting to see prices increase again. Again, this is general. Different asset classes are still going down, but others are going up. But in general, you're starting to see things pick back up again. Obviously, the Fed recently cut the first 50 basis point cut was just last month. And so you have a situation where the rate hike cycle is in the rearview mirror. And now we're looking forward at a cutting cycle, which is quite advantageous, we think, for a few reasons for commercial real estate, Danny. The number of transactions that have essentially dropped off a cliff the last 2 years is a big part of the property price declines, right? There's less people coming to the table and saying, I will pay what you're asking or negotiating on a transaction. A lot less deals were getting done. Now that we're seeing, this change in the market shift, we're going to see, or already starting to see more transactional volume, more demand from buyers coming back into the market. Borrowing costs, are lower than they were before. We'll see where they go, which obviously helps deals pencil if you can borrow for a lot less. And you also have this psychology effect where there's been a lot of money sitting on the sidelines waiting. And a lot of them were waiting for distress, and a lot of distress never really came. And so you might say to yourself, and we're seeing this, it's like, okay, well, 2025, we're going to start buying again because we're getting a great price comparatively to where it was before. And hopefully borrowing rates will be lower. And now's the time to get in. So you've got kind of a pivotal moment that we're in that we think where the market correction we've gone through the last couple of years is most likely in the rearview mirror. And we think it's going to be a really good time to be buying for the next, call it 18 months or so, Danny. That's my assessment. Where things go from there, because you did say 5 years.
Yep.
Anyone's guess, but on the housing side, we're starting to see rents pick back up again for apartments. We're seeing occupancy pretty stable over the last 2 quarters. And again, you have this outsized demand for affordable housing. There's just not enough of it, and the demand for it keeps going up. And so we're seeing supply really start abating in 2025, or for apartments specifically, and demand continuing to increase. I think, there's a chance that in 3 years, give or take, we're in another situation, not quite like 2021. That was a very hyper fast moving market for rent growth. But we do anticipate, we don't underwrite to it, but we anticipate we'll start seeing significant rent growth again in certain markets where you have insufficient supply and high demand. And so I think the worst is behind us and that we've got much better years ahead. All this is, of course, big asterisk that there's no black swan event, no World War III, no major meltdown in our current civilization. And so I think it's a great time to get in over the next couple of years.
Yeah, no, I only laugh because it's like, it's crazy the amount of, it just feels like it's kind of like clockwork, right, Mark? It's like every 4 years we go through the same thing around election season. Everyone gets all doom and gloom. And then the holidays happen. And then January 15th it comes and goes and everyone forgets that they were ever scared. And then it's like business as usual for the next 3 years until the next election. And then, obviously we have some geopolitical issues right now that have been, I think, wearing down consumer sentiment, and then obviously the economic woes. But all in all, I don't disagree with you. I mean, I right there with you. I'm hoping the worst is behind us now. There is one little caveat here for the last year and a half, 2 years almost. Every conference I've gone, every hotel conference I've gone to, talk to the same guys, right? You see the same people. But 2 years ago, we talked. And everyone's like, 2023 is the year. It's like shit's going to hit the fan, blood's in the water. It's going to be, doom and gloom and all these things. And then same conference in 2024, same thing, we all, it's going to happen, it's going to hit the fan. Right. And then, like midway, like maybe like spring of 2024, everyone's like, hey, why hasn't it hit the fan? So it's interesting where someone called it delay and pray. We're in the delay and pray portion of the cycle, right? And so there are some people who I feel are very intelligent people, know a lot, who don't think that. They think the worst is not behind us. They think the worst is yet to come. And so it's interesting to see, what I would consider like equally informed people, equally successful people on like either side of that coin. And so it's just interesting to hear everyone's perspective. And I'm an eternal optimist. That's the entrepreneur in me. So I'm gonna say that you're right, buddy.
Yeah, look, nobody knows, Danny, right? I could paint the whole picture just like you did, or the other side of the coin. As long as you're investing with strong fundamentals, with great people, and you have enough time to ride out a market downturn, not force to sell at the wrong time, you should do well. And that's the beauty of the business that we're all in, right? Commercial real estate. If you look at it for long enough, it's up and to the right. Just got to ride out the downs. And we think we've passed through that. We'll see. And I'll just lead you with the last comment, like Warren Buffett famously says, don't ever bet against America. So let's go.
USA. I love it, man. Hey, Mark, in traditional Gould Mine fashion, I'm going to have you leave the audience with one final gold nugget. Take it away.
Golden nugget. Okay. I think I would just say focus on diversification as your investor. Okay. Not just asset class, but people. People are one of the biggest risks in this business next to debt. And so if you're going to invest passively with people, take your time, go slow, earn that trust, and spread your capital across multiple people and multiple asset classes. You'll do much better in the long run.
I love it. Mark, thank you so much, man. This was great. I learned a ton, and I'm sure that the audience did too. And who knows, we might have you back in the future.
Yep. Happy to do it, Danny. Thanks for having me on.
All right.